Justin, you shared some really, really cool, in-depth examples. The dog training company from the first half, which I think was such a unique story, but a great example of the application of this lifestyle investing, cash flow investing concept. And I want to dive into some of the 10 commandments that are in your book. You have 10 commandments for the lifestyle investor. But I want to tie them back to examples because I just found a ton of value in you sharing that one. And you did also share that you have many, many of these examples. So let's dive in a little bit. I want to go to two of the commandments. And again, I hope our audience can dive into Justin's book. It's really valuable. It's a really unique perspective, and you'll understand the references from the podcast here. Commandment 6 was find an income amplifier. And then commandment 7 kind of went along that with plus the deal. I'm going to challenge you here, and I'm going to say, with those two commandments, do you have any examples or even parts of different acquisitions or deals you've done where you're applying those commandments?
Yeah, I mean, I could give a number of different examples on this one. I mean, my goal is that I'm always trying to negotiate a piece of upside. So finding an income amplifier, it's just like, the example I talked about where I find someone willing to give me an equity kicker or give me a warrant kicker, which is just, an option to buy more equity at a set price at a later period of time. Should that company be performing well, I have the right to execute that and own more of it. And I just like when I can get that for free, And so the whole idea of like find an income amplifier, it's how do we make this deal better? Like when someone gives you a deal, it's probably good for them already. They're the ones that are presenting it to you. That doesn't mean it's good for you. So like for me, I've got to evaluate what they gave me may be a win for me, but it might not be. I don't want to just take it at face value. And then the other thing is generally people want different things. So there are certain terms that some people want. There are certain terms that other people want. I have found that usually I want different things than what other people want. So for them, if it's a certain sale price, then I'm happy paying that sale price. Here are some of the, things that I would want for that sale price. So that's kind of how I look at that one is like, what else can I get? How can I make this deal better? Can I get some things for free? So that's my mindset there. And then going one step further on the next one, which is plussing the deal. So maybe I get more. This is a way to say, hey, can you also add this to it? But it's also a way to protect the deal. So maybe it's not getting more. Maybe it's just getting better protection. How is this deal collateralized? Let's say that because I try to look at every deal like it's going bad. So if this deal goes bad, how can I lose? Okay, well, now I know how I can lose. How do I protect against that? Right. So a lot of the time, I'm just really trying to, protect the downside risk, whatever that might be, whatever that might look like. So let's talk examples. I mean, I gave one in my book that I think is very fitting for this because one of the things that I've found, I mean, I started investing in e-commerce really early, which is another, when Commandment 3 is talking about invisible deals. And I like finding like off-market deals, but it's also talking about like trends and like what is to come. What are buying habits or shopping habits of millennials, because that's going to be in vogue. And it's a huge group, right? So like this is the future of the way that the masses are going to be spending money, right? The people that are actively spending the most money. And so I saw e-commerce being one of those. I saw cannabis being one of those. I saw mobile home park investing. A lot of these, single family home rentals, I got into that early, like before it was even deemed, or I guess right after it was deemed an official asset class. And so these are all trends that I noticed that I thought made sense to get into, not just because I'm hoping or predicting that this is the trend, but if I'm wrong and it's not the trend, I'm pretty protected to not lose money on the way out. Does that make
Nice.
sense? So I have a
That
hard
makes
time
sense.
taking a big risk and saying, hey, I think the future is going to be here, unless that risk says, hey, and if it's not here like I think, then the max I can lose is this, or it's collateralized to the point of my total investment. So at a minimum, I get my money back, right?
Hmm.
So that's kind of how I analyze and assess these. So we can use an e-commerce example because there are a bunch of brands that I've helped buy out of bankruptcy. The first one was Dress Barn, which is a women's fashion retail clothing store. The Ascena Group owned that brand, and they were cutting it loose. It was about to be in bankruptcy. We bought it out of pre-bankruptcy, and we bought it for a killer price, just for a few $1,000,000. But we bought the brand name that has been in business for 60 years. We bought
Mm.
the IP, we bought the customer list. So it's the difference between a startup, which is like you're starting a brand new brand, or a late stage company where you've like most of the risk is done because it's trying to get the brand recognition, you know? So this was really interesting because we knew, and by the way, we got an offer to sell it for twice as much as what we bought it for the week afterwards. So we knew we were onto something. But I put my money into that deal. I negotiated a note, and inside of this note, I negotiated monthly distributions, 20% interest. So these payments are, so every month I'm getting a payment. At 1 year, I get all my money back. It is senior secured. So I'm in the first position. So if anything should go wrong, I get to take the brand. I get to take the IP. I get to take the customer list. So that was a unique structure. So downside,
Wow.
very protected. And then I was able to negotiate, one income amplifier was a cash bonus at the end. So when the deal closed, another 10% return on my money. So at 1 year, I get all my money back plus 10%, plus 20% over the course of the year. So in effect, it was a 30% return. Okay. And
Hmm.
then I negotiated another income amplifier, which was an equity kicker. And so that equity I got all my money back in a year. But I still have equity in this brand, and this brand now is crushing it. It's e-commerce only. We closed all retail stores. This thing has scaled beautifully. It is net positive, so it is EBITDA positive, and it covers its own debt service, which is really impressive to do inside of a year. Now it's been a couple of years, but technically it's been 3 years now. But after that year, I had all my money out. So I was in a risk-free position with only upside,
Man.
which is really cool. So that's one example. And you can do this, like I'm giving this example, you can do this with all kinds of businesses. We did this in the cannabis space as well, where there are, about 200 regional banks that can actually open up accounts. It's federally illegal cannabis, but state by state, there are different laws and rules. And so federally, the big banks, they can't do anything. There's no lending in this space from a banking standpoint because it's federally illegal. But there are banks that are opening up accounts, so you can actually see the financial transactions. You can actually audit it and know that these companies are doing really well in one of these 200-ish regional banks. And so we found a bunch of companies that are killing it, but they don't want to give equity away because they know how valuable their brand is. So we can negotiate some killer interest rates, anywhere from 15 to 30% with
Hmm.
warrants and equity kickers, right? This is just free. So we get all of our money back. I've done countless deals where we get all of our money back inside of a year or 2 years or 6 months or whatever it is. But then we have equity in the company. And we got cash flow during that period of time. And these have been very fruitful for us because I can get in and get out. I can repurpose that money. I've got upside. I've got cash flow the whole time. And a lot of the time when I do this with the bigger groups, maybe in a fund structure, I can negotiate preferred terms for my mastermind, for my group of
Hmm.
people that want to join the investment with me. And so maybe we get lower minimums or reduced fees or increased returns. I mean, all these things are things that we've negotiated into these deals.
Wow. You know, I think a lot of this, it sounds unique to deals you're doing. Maybe people haven't heard this before, but I just love being exposed to some of the ways you're structuring this. And I mean, some of it's just having the tools in your tool belt to be able to put deals like this together and have the knowledge around the negotiation. So I want to walk through this a little bit. I like practical examples. If let's say I'm a cannabis company. I'm in Fargo, North Dakota, and we know that we have a future in this space. North Dakota's on the way, like you mentioned, with many states. And I love my brand. I love my company. But I need to take on investment. I need to take on investment to grow. A lot of these companies, I would say, Justin, are probably in that space where that's why they're looking into this. Is for scale. Is why they're entertaining other investors, right?
Yeah.
And so then you're coming to me and you're saying, "Hey, I'm an investor, I'm a group." And like I said, I don't want to give up equity, but you're structuring this deal in a way where you're going to be a debt investor, Justin, and walk me through maybe what you would offer me in this situation and why this would be a plus for me and why this would be a plus for you as the investor.
Well, most people are used to equity only investments. Like the vast majority
Yes.
of the world, they're investing in the stock market. I mean, that's almost exclusively a true,
Yes.
on the equity side, that's true equity play. Or you're investing in a company. Maybe you're an angel investor, which is the riskiest way to invest. Generally, it takes 100 unique investments to get one that actually wins, that has a big
Wow.
return. But a lot of people don't know it's that risky, and they think, oh, I got the inside track, I'm going to invest in this early stage company, only to
Yeah.
find out that it didn't work out. But they don't find it out for 20 years. So they've done that same thing for 20 years, right? So most people just, when they think of investing, they just think of investing in equity. I put X amount in and I get this percentage of the company, or this percentage, this many shares, right?
Yeah.
Um, but that's not always the most efficient way to invest. Like for a lot of people that think that their company is going to be worth a ton, they would rather pay really high interest
Yeah.
than to give up equity. So what if you could pay, like, what if I could structure a deal and say, hey, and by the way, I didn't say this before. So like one thing that I do no matter what is to make it not risky is I want to collateralize all the assets you have against the money that I'm putting in, right? All the
Yeah.
assets of the business, in states where they restrict the cannabis license, the licenses themselves are worth
Wow.
anywhere from 10 million to 100 million. So you could just collateralize against that license and be way ahead. So for example, like let's say I'm putting in, or my group is putting in $1 million, but we've got an asset that's worth $10 million. If you default, we take that, right? So
Yes.
there's just, it's so hard to lose money when you set it up that way. So that'd be the first thing. Like, do you have real estate? Do you have equipment? Do you have a license in a restricted state? Do you have, like, sometimes it's membership interest that we collateralize with. So if you don't, if you default, if you don't do as you agreed to do, then we get to take over part of the company. But people are willing to do it because when they know their business is good and they
Yeah.
can figure that out, then hey, this is kind of par for the course. So yeah, I would make sure that there's assets that collateralize the loan. I would say, I want it to be a good return, a good interest rate.
Mm-hmm.
Since there's no lending in the space on an institutional level or on a banking level, there's no competition. So rates tend to be pretty high. And
Yes.
then I would
Yeah.
say, hey, I'd like a little equity. I want a little upside. I'm not
Mm-hmm.
I'm not investing for straight equity, but I want a piece of it. It doesn't have to be big, but
Yep.
I'm hooking you up with what you need today. And I'm, foregoing investing straight equity. So I just want a small piece along with the interest.
Yes. Yeah. Man, again, I like to get exposed to just how your perspective behind this, and I think that's what a lot of your material does. With shifting to Commandment 10, which is every investment dollar gets a return. There was some really cool quotes that you had in the book, And it was one of the things you said is no one can ever foreclose or bankrupt your brain. And so you talk a lot about investing in yourself, investing in coaching, investing in the knowledge, investing in podcast listening like this, and learning how to structure deals like this instead of on the job. That's going to stick with you. And then Kiyosaki has a quote where I want to ask you this question. You said this quote in the book: business owners can stop running a business, or the definition of moving from business owner to investor. Kiyosaki says it's when a business owner can stop running their business for over a year and it actually grows in the time without them. And that's when when it's an actual business and not a sole proprietorship is where the quote comes from. And it talks about the concept of moving from business owner to investor. And I think so many people in this space of passive income financial freedom have opportunities in business, opportunities, like this dog training company, but then they get stuck in the business owner seat. And you've been intentional to know that you've been there. Your goals for lifestyle are outside of that quadrant. They're in the investor quadrant. And I think I just want to hear maybe how you've done it. I mean, maybe we know some of the how, but how some of our audience members could really get out of that business owner seat and kind of rip that Band-Aid off and get into a passive income financial freedom lifestyle where that dog training company is running itself because of how you structured that. And a lot of that's finding your partner. That was part of that. But just speak to that a little bit, Justin. I think that's a huge thing in this space.
Yeah, I love this commandment. It's one of my favorite commandments, and I can expand a little bit on it because it's not even just the actual dollars getting invested. It's the education that you learn when you spend those dollars, right? If I'm investing in a CPA to do the work, an attorney to do the work, like I don't want you to just do the work. I want you to teach me what you're doing and why you're doing it so that I have a foundation of more knowledge and education for later. The whole reason that lifestyle first is my very first commandment for cash flow investing is because I don't want to fall in the trap of buying a job. A lot of people buy businesses, but they don't realize they just bought a job. They just bought more hours of working. And that's not the trade that I want. So I might leave opportunity on the table, meaning like I could optimize better. I could maximize return better. But my goal is not to maximize return. My goal is to maximize lifestyle. So how do I get the best return I can, but keeping the priority in place, which is my time is my most valuable resource. And the people that I spend it with, that's so meaningful to me. So I'm very intentional about when I work, when I don't work. And I don't want to not work. I actually enjoy working when I'm focused on the things that really fill me up the most and the people that fill me up. But I like having an extended weekend. I mean, I have extended weekends every weekend. Fridays and Mondays, I don't schedule stuff like that's. I like to work Tuesday to Thursday, and I like to have some good time and some good energy, some good creative sessions. But at the end of the day, like I'm optimizing my life, my health, my relationships. And that to me is just so important. And I think if I have to leave a little equity on the table, some people look at me like I'm crazy. Like even when I left, my business originally, once I replaced my income that I was earning, people are like, "You're crazy. You could be making twice as much." But that was never the goal. I wasn't trying to make more money. I was trying to buy my time back. And so I think that culturally we get stuck in this trap of like, I'll do whatever it takes to make more money because that's the highest priority. That's the most glorious thing. But from a true wealth standpoint, I mean, one of my favorite quotes is that the whole idea or difference between rich people have a lot of money, but wealthy people have a lot of time, right? And so that's really what I want to own.
That is such a refreshing thing for everyone to hear, and it's right along what's your priority? What's the goal you keep coming back to? And you said your goal was lifestyle driven. Your goal was lifestyle. I mean, and the money is always going to be that carrot that floats in front, and it's going to lull you into buying another job, as you put it. I think that that's so important. Justin, we were in that business evolution circle that I mentioned earlier in the podcast, and you had spent some time with Richard Branson this last year. And you spent a lot of time. I'm sure you said you had pages of notes, but you had one major takeaway, and I'll let you share from there.
Yeah, and first and foremost, Richard's an amazing guy, super down to earth, wonderful to hang out with, treats you like you're the only person around, and like he really enjoys being there. It was quite the experience. And I had 7 days of wonderful time with him. But I think the number one thing he said, if you want to be a great entrepreneur, and this is a man that owns almost 500 businesses, right? He said, if you want to be a great entrepreneur, then you need to get out of the building. You shouldn't run it. You need to hire people to run the business, and you need to get the heck out of there. And so that's so powerful coming from him. And he's got all these successful businesses because they don't depend on him. They don't rely on him. He has teams that run them, and he can work through them. He's kind of like a chairman of the board, not a C-suite executive. He's not the president. He's not the chief operating officer. He's not the chief financial officer. He is like a chairman of the board that, pokes his head in to make sure things are going well, and connects with key people in some sort of a cadence, but doesn't run any day-to-day in any business that he has.
Wow. And that's crazy to boil it down into a takeaway like that. I know for a fact there's doers listening to this podcast. I'm one of them. And I get drawn into getting my hands dirty into the rental properties we own locally, or the business operations, or the meetings that are discussing what's happening. And getting out of the building sounds scary. I'm sure some people are like, how could I? But again, Kiyosaki's definition is if the business is running and you're not part of it for over a year and it's still growing and thriving. And if we're following the cash flow quadrant of starting and running a business is different than investing and buying businesses. And that's what we're talking about Richard Branson doing in that quote. And I just want to urge people that are doers, that have their hands in the cookie jar constantly. I'm speaking to myself. For listening to some of Justin's wisdom in this and Richard's wisdom in this, how can we move into this true position as investors and key in on our actual goal, which is freedom and lifestyle? I think that's such a takeaway from our time with you, Justin. And I just appreciate you being here, man. This has been a really, really fruitful experience to get to know you, be in Front Row Dads with you, and then for you to come on the podcast.